All right, hello. My name is Eric Whiteman. I'm a first year at the United States Military Academy, majoring in operations research. And today I'll be going over a quick overview of my SE370 final project. So this final project, I thought was very interesting. We were given the latitude to kind of choose whatever topic we decided to go with. For me, I know that being a recent recipient of the Cal loan and going out into the future very soon, I wanted to set myself up financially to be successful and later in life. One of the things that I've started to delve into as I age and go a little bit farther in life is the stock market. This is generally something that's pretty obscure at some points. It can be complicated to understand, and the idea behind this project was really developing a way to, in some ways, predict the stock market, which, of course, is people have tried to do since the beginning of time. However, I decided to use some of the applications of methods that I've learned while at the United States Military Academy to streamline this a little bit. The method I decided to utilize was Monte Carlo Analysis. And the big question, what I was trying to answer in this project was, can I use previous stock performance to, in some ways, predict the future, see how those stocks are going to perform given a certain timeline and historical trends that they've been following for the last roughly 15 years. So I understand that this is not supposed to be a very technical video. However, I think that the code I wrote is very applicable, and understanding it fully can ease interpretation of some of the output from what it's saying. So very quickly, I'm just going to run through what I did. So the first thing I needed to get was some data to work with. What I decided to do was I web scraped some data from websites that I frequent before this project, trying to gain some insight on stocks. These two websites was the CNN Hot Stocks list and Yahoo Finance trending ticker. So both these websites, CNN and Yahoo Finance, obviously have different components from their websites. However, when you're looking at the market, for people trying to make quick money like myself, kind of looking at these hot stocks is definitely a point of interest for each day. So just quickly to show what these websites look like, this is the page for Yahoo Finance hot stocks. So it gives stocks with a large amount of movement for that day. And jumping over to CNN, shows activities, right? So these are stocks that are moving a fair amount in comparison to others, gainers and losers for the day, right? So what I did is I scraped that information from each one of those websites into their own lists, and then I compiled those lists into one mega list, right, with both stocks, information from those websites. What I did is I just cleaned that in this list right here, and I was given this vector, this list, which I named money, and vector 1 is really just the first component of that list. So here's just a quick list. On the left side we see the stock index ticker. On the right side we see the number of instances that stock is observed. So if there's going to be a 2 next to each one, it'll show that both websites mention the stock, meaning that there's potential it has a larger amount of movement than other stocks present. Both websites are identifying this as like a hot stock to look at. All right, so from there, now that I've got my data, I created just 5 empty lists. What I was going to do is I knew I was going to create a Monte Carlo analysis and a for loop, so I wanted to create some empty vectors for the information from that for loop to be placed into. All right, scrolling down to the meat and potatoes of it. So this is my for loop for the Monte Carlo analysis. So I use a couple of packages. One of them was a package called quantmod. Right, within that package, there's a function called get symbols, and what this function right here does is it pulls the stock information given a time range for whatever index you're searching for, which I defined as y. Right, you're looking for y index in my vector. So if we go back to money real quick, we can see that there are 57 indexes that we're pulling from, and we want to analyze those. So this for loop is basically taking each one of those indexes and running it through. So for my first one, we had IXIC, right? So it's going into get symbols, it's pulling all the information for IXIC from 2005, January 1st, 2005 up to May 9th of 2021. All right, so it's trying to get the most recent information. I compiled some information, some logarithmic returns, and then normalized them to find the average stock daily return based on the last 15 years that we can expect given that index. Once that's in and I've saved that, I set some criteria for a random walk, right, which is a precursor to Monte Carlo analysis. So essentially what this is doing is it's taking the most recent price and either multiplying that in a positive or negative manner at complete random for a given set of time, right? So in a year there's 252 trading days. I wanted to set this out to a 4-year time horizon. So I multiplied that out to get 1008 total trading days for a 4-year random walk. And I wanted to do 1000 simulations of this. So this Monte Carlo analysis is doing 1000 simulations of 4 years given historical trends for the last 15 years. All right. So I go through, I run my Monte Carlo analysis, and I'm given some information for each stock, right? I'm placing these back into these empty vectors that I defined earlier. And if you look down here, this is output I have, right? So my table, I'm given my equity name. I'll dive into this a little bit farther. My 50% confidence interval return I wanted to specify, right? So this is my potential upside given the current stock price, all right? The multiple that you can expect within 4 years. The most recent price for the equity. And then I'll pull this up a little bit later. I'll give my confidence intervals, right? So at 0.5%, 2.5%, 25%, 50%, 75%, 97.5%, and 99.5% confidence interval. So it gives some good bounds for what we're looking at and what we can expect, right? So I'll go into my Flex dashboard, pull this information up. So again, here's that table I just referenced, right? Which with each equity, we can go, right? We see all 55 equities that we were looking at, right? They were able to pull information for. This 50% confidence interval return, what this is it's just the most recent price. I'll pull this back up over here, see if I can find it in the list. Upside, so it's the confidence interval, right, of our 50%. So that's like our mean value that we can expect, and it's divided by the most recent price. Second, that shows the upside. So for, let's say, KR, right, current price of 37.73 based on historical trends. If we look at our 50%, we can expect it to get up to $46, or essentially 1.22 times its current price, 22% upside. All right, and we're also given some bounds. So I thought this was really interesting, right, because it gives an idea of what we can expect based on the historical trends. So we'll go to our upside, contrasted with 50% confidence interval. So we see all our equities that are plotted right here. On the x-axis, you can see the potential upside compared to the current price for the 50% confidence interval, and then here's the 50% confidence interval plotted on the y-axis. All right, so obviously some of these equities have really high 50% confidence interval prices, right? For this one, it's about 17.49, or excuse me, $42,000, all right, and an upside of 1.267, all right. So that's IXIC. I think it's important to understand that, like, hey, even though this looks like great, we're making so much money, it's only 1.26 times its current equity price. So obviously this is a pretty highly priced equity right now, all right. And again, this is just movement that we can expect, all right. So one thing that you're always worried about is volatility. So what I looked at with this is just some confidence intervals. So the black dots plotted are our 50% confidence interval, and the error bars depict our 25 and 75% confidence intervals with it. So some stocks that have a greater amount of volatility are going to have error bars that are much farther away from that mean value, right? So it's always something that you need to be worried about, when you're looking. So it's good to contrast, like, hey, I want to look at the upside as compared with my volatility, right? Because some people who are riskier traders might say, hey, that's great, I don't care, I'm still going to make that investment. And other people might want to look at a stock with a good upside as well, right? But a lower amount of volatility, right? Much tighter kind of error bars. All right. So finally, we want to look at our instances of stocks being mentioned on the hot list. All right. So what this is just a text counting of times that these stocks were mentioned. So these are all one, so they were just mentioned one time on their respective hot list. However, we see one stock that's mentioned 2 times on their hot list. Going down, we can see that's Pfizer, PFE, but it also gives some insight to the user saying like, hey, if both stocks are mentioning this, maybe we want to take a look at it. So again, I think this is something that's extremely applicable for anybody who's looking to gain some more insight on stocks. It allows you to contrast multiple stocks at one time. It's easy to do a sort and say, hey, wow, look at these upsides, right? Compared to, like, I want to look at something that's got a really high upside given historical trends, NIO, the trade desk, or you can look at the confidence intervals compared to the most recent price, and it gives you a really easy, quick understanding of, an idea of what you can expect given historical trends. Again, Sir Class, if you have any questions, please don't hesitate to reach out, and I appreciate you listening to my brief. Thank you.